Hi guys, I'm Ahana and welcome back to my channel. In today's video, I'm going to be talking a little bit about the world of venture capital, specifically what is VC, and if raising money from venture capital investors is really the right choice for your business. If that sounds good to you, then keep on watching. We're all used to seeing the TechCrunch headlines of this company has raised the hottest round in Silicon Valley. And it all sounds very exciting and glamorous, with all the glitz and glamour that comes from raising money from VC investors. What is the true cost to this? Well, as someone who has raised VC funding, that's what we're going to be diving into today. So first, what is venture capital or VC and how does it actually work? VC funding is a type of private equity capital. What this means is investors invest cash into businesses in exchange for shares in the company. Normally, this will be at the relatively early stages of the company, and the investors will be looking for businesses with high growth and scalability potential. In terms of how the VC fund themselves are structured, well, firstly, they need a pot of money to be able to invest in companies. Where do they get that from? So that pot of money comes from what are called LPs or limited partners. These LPs are the investors that provide the funds to the venture capital firm so that the venture capital firm can invest into startups. LPs can be institutional investors like pension funds, endowments, insurance companies, but LPs can also be wealthy individuals and family offices. There are also some corporate venture capital firms where the funding is provided by the corporation themselves. So for example, Google or Microsoft, they have venture capital arms, and that pot of money comes from the corporation itself. LPs commit a certain amount of money to the venture capital firm, and this money is managed by the GPs, or the general partners at the VC fund. So these GPs manage the fund. This means that they're responsible for making the investment decisions, managing the fund's portfolio, and ultimately generating returns for their LPs. GPs will often have backgrounds in entrepreneurship themselves, or they may come from a finance background or have niche expertise in one specific field. Now, let's dive into how VCs make money. What is their business model? Apologies ahead, there's going to be a lot of acronyms in this one. So as we've established, VCs raise money from LPs. The exact lifespan of the fund will of course vary depending on the VC firm and their LPs, but typically we'll see life cycles of around 10 years. So this means that in 10 years, the VC has to make money for their investors, for their LPs. VCs aim to eventually sell their equity stake in these companies that they've invested in for a return. This is known as an exit, and this is seen as a successful outcome for a VC investor. Now, the VC has a responsibility to make the returns to their LPs, but they need to make some money in the process too. And there are two main ways that VCs make money. The first is through management fees. VCs will typically charge an annual management fee, which is normally around 2% of the total capital committed to them. And this is primarily to cover their own operational expenses. Then we have what's called carry, or carried interest. And this is a share of the profits. Normally, carry is at around 20% for the fund. So they only really earn this carry if their fund and those underlying investments actually perform well. And doing this ensures that the interests of the GPs are aligned with the LPs, as the GPs only receive carry if their investments are successful. Given that VCs need an exit back to their LPs, there's a big focus on time horizons in the land of VC. Not only do you need an exit, but you need it within a specific time window. Otherwise, the fund doesn't make any money and their investors don't get any money out of it either. So essentially, without an exit, the VC fund cannot demonstrate their success or provide returns which will impede their future fundraising efforts. If you're an LP that's put money into a VC and you don't get your money back, are you going to invest again? Probably not. So that's why VCs, when investing, will make sure that you have an exit plan ahead. Now, in terms of the exit itself, that can look like a couple of different things. And I'm going to walk you through some of the scenarios that VCs are talking about when they talk about exits. One common exit strategy is an initial public offering, or an IPO. This means that the company goes public, which allows the VC to sell their shares in the stock market. Another exit strategy is acquisition, which means that another company buys the startup, which then provides liquidity to the investors, like the VCs. And another option is a secondary sale, which is where the VC sells their shares in the company to another VC fund or another firm. So VCs are typically looking for exits within the 5 to 10 year time horizon. This time frame aligns with the life cycle of the fund and the growth cycle of high potential startups. Some investments may take longer to mature, while others may exit sooner if the company growth is really, really quick. So what does all of this mean for founders like me? What are our interactions like with VCs and how did they go about making their investment decisions? Well, the decision-making process at a VC firm typically involves a fairly structured and rigorous process that normally culminates in a formal review by an investment committee. Here's how the process normally works. So the first step is actually sourcing deals in the first place, finding potential companies that could be good investments. VC firms source potential investments through a variety of channels. This can include personal networks, referrals, industry events, and direct applications from startups. Some firms even have have dedicated teams or venture scouts who are typically responsible for sourcing deals. Then the next step will be some sort of preliminary evaluation, which is an introductory call with someone from the fund, and this will typically be with someone more junior, like an analyst. This initial meeting is really for the VC to meet the founder, understand the business model, the market opportunity, the team, and the financials. Then if the analysts or the junior partners like the company and see there being real potential, they'll start to conduct some due diligence and move the conversations forward internally. This could mean that they go back and conduct research on the market size, on the competitive landscape, on the business model. It may also involve customer references or trying the product for themselves. While this is going on, it's likely that you'd have another follow-up meeting with the fund, this time with somebody more senior, perhaps one of the general partners. The contents of this meeting will likely be quite similar to that of your initial meeting with the fund. The questions will be mostly the same, except now you're talking to the person who has real decision-making power. If that meeting goes well and the due diligence is favorable, the fund may issue you a term sheet, which is a non-binding agreement proposing the investment terms. And this sets the stage for final negotiations. The key terms in the term sheet are things like the valuation, the investment amount, the equity stake, board seats, liquidation preferences, and other rights and obligations. As the negotiations are happening, the deal will be presented to an investment committee, which is typically composed of all of the senior partners or the general partners in that fund. And normally the partners that you've been speaking to are the ones who will be advocating for you in that investment committee meeting to try and get everyone else at the fund on board. The investment committee then go and review the investment opportunity, asks questions and debates whether the investment is a strategic fit for their portfolio and investment thesis. And the investment committee makes the final decision as to whether to accept, reject, or require further information from the potential investment. Decisions can be made via consensus, majority vote, or unanimous agreement, depending on the firm's internal governance processes and internal structure. If the investment committee comes to a decision on investing in a company, the last step is really just around getting all the documentation in place, making sure the legals are up to scratch, and making the investment. Once all the documents are signed and the conditions met, the investment is closed and the funds are finally transferred to the startup. After the investment has been made, there will typically be some sort of continuous follow-up with the fund that has invested in your company. Most companies will send out monthly updates to their investors, highlighting their progress, asking for help where it's needed. And generally, the larger the check from the investor, the more hands-on they're going to want to be. And in particular, they'll want to be assessing the company's progress and trying to help wherever they can. So that's how the process works. What does this actually mean for founders who are considering raising venture capital? The first thing to think about is dilution. Raising VC funding means giving up a portion of your company's equity, which dilutes the ownership stake for you and maybe other early investors, potentially angel investors. The second consideration is around control. VCs will often ask for board seats and may have significant influence over the company's decisions, especially if things aren't going as planned. The third consideration is around growth pressures. As we've talked about, the VC needs that return to be able to make money and keep their own fund alive. So to do this, they do expect high growth and significant returns on their investment. This can create pressure to scale rapidly and sometimes at the expense of other business considerations. And the fourth consideration is on the exit focus. Since VCs need exits, they will push for strategies that maximize the likelihood of an exit. And this may not always align with the founder's vision for the company's future in the long term. So to summarize, VC can provide the capital, the expertise, and the network to grow a business rapidly. But as with most things in life, it comes with some trade-offs. It's really important for founders to consider these factors and align their own goals of their potential investors before pursuing venture capital. It's really important to look beyond the glitz and the glamour and actually ask yourself, if you have a business need for capital, is venture capital the right option for you? And it may well be, but if it's not, that doesn't mean that you're not destined to build a successful business. There are other funding opportunities available, and building a venture-backed business isn't the only way to build a successful business. It's a means to an end. It's a tool to provide cash for companies. If it'd be helpful, I could make a whole separate video on alternate sources of capital. These would include bootstrapping, self-funding, friends and family, angels, crowdfunding, grants, competitions, loans, credit lines, revenue-based financing, strategic partnerships, venture debt, or family offices. Let me know if you want to see a video explaining all of these different funding sources. But for now, that's where I'm going to leave this video. If you enjoyed this video and want to see more content like this, please give this video a like and subscribe to my channel. Alright, that's all for this one. Thanks for watching, and I'll see you in the next one.